Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage-eitel.
All right, my name is Mark-eitel, and you are tuned into the Mr. Mortgage Show. And friends, you are in the right place if you want the data. Not the scary headlines, not the sky is falling, not the boogeyman is hiding around the corner, but the data, the tips, the tricks, the strategies, the answers to your questions so you can go out there and make better real estate and mortgage decisions for you and your family. That's what this show is all about. And man, oh man, we've got an amazing show lined up for you this week. We're going to dig into the recent aftermath of the bank collapses and what effect that's having on housing and mortgages and everything, what it's doing to interest rates and where it's likely to go from here. We're going to dive into all that. We're going to dissect some of the headlines of the week. And certainly we're going to take your questions. Your questions are always my favorite part of the show. If you have questions or comments, you can call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen, my producer, is standing by, womanning that hotline, and she'll get your questions on the air for you. Again, that's 855-462-7292. If you prefer to shoot us an email, just visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click on that email icon, and you can shoot your questions over that way. Hey, but before we dig into all of that, I had an amazing conversation with a gentleman this week who has cracked the code on how to earn cash back from renting his apartment. And I thought, mind blown, because you guys hear me preach the benefit of ownership all the time. Good market, bad market, high rates, low rates. I can almost always find an example that shows it made sense for somebody to own property during that time period. So in this conversation, I was super intrigued, and I've got to say, I really admire the creativity. This young man convinced his landlord to let him pay his rent with his cashback card, and I believe it was a Discover card, but he's getting 5% cash back. So we were talking, and I said, you know, how much is your rent? Well, it's $3,000 a month. So he's paying $36,000 a year on his cashback card. And that's the only thing he uses the card for, which is quite brilliant because he's got an amazing credit score. Ironically, he's considering buying. So we were just looking at the pros and cons of both. But every once in a while, he'll get a better offer on a cashback credit card and he'll start paying with that. So he's really done a good job to try to maximize some kind of return on rent. So $3,000 a month and currently getting 5% cash back. So he's getting $1,800 a year in cash back just for paying his rent. Kudos for him because very, very few people are that creative, and he's getting something back where most people are getting absolutely nothing other than the, opportunity to live in that apartment. So anyway, we're talking about him possibly buying a property. So I was fascinated by what he's accomplished with this strategy. He's been renting for about 10 years and not always at $3,000. It's increased consistently and significantly over time. But if you figure 5% at $3,000 for 10 years, that's about that's about $18,000 in cash back from renting an apartment, which is amazing to me because that's almost half a year, or it is half a year in free rent. So phenomenal job in doing that. But then we looked at ownership and where he's looking for that money. He could buy a $350,000 property at today's interest rates with an FHA loan and have a payment of, give or take, taxes and insurance. It might vary for where you are based on taxes and insurance, but around $3,000 a month. So I wanted to be super conservative in this analogy because I knew as soon as I talked to him, I was going to share this with everybody on the air. Let's use a anemic 3% appreciation rate. And guys, I pulled all the data I could find this week, and it looks like historically, depending on whether it's Realtor.com, Case-Shiller, whether it's the St. Louis Fed, all of the data sets vary slightly, but it looks like we've averaged about 5% appreciation historically. So let's chop that down to 3 to be conservative. So if you bought a property today at today's interest rates with an FHA loan, a $350,000 property, in 10 years, he would have paid down $53,000 in principal. So right off the bat, if properties never appreciate, he's created $53,000 in equity wealth. Now, remember, $18,000 is what he created with this rent hack, which is brilliant, but far less than $53,000. Now, the cool thing is, over that 10-year period, that fixed rate mortgage payment didn't change. Yes, maybe taxes and insurance varied, but the meaty part of that mortgage payment stayed the same, where in 10 years your rent is going to be more. We're not even factoring any of that into this analogy. So $53,000 in wealth creation just by reducing principal. Now, if we apply that very anemic 3% appreciation rate over that 10-year period, that property is now worth $470,000. An additional $120,000 in equity wealth, this time by the property appreciating at 3% annual appreciation rate. So $173,000 in wealth creation versus $18,000 in cash back. And needless to say, he was super excited to dig in and start looking for a property because he's all about the money. And the cool thing is he found a way to put $18,000 in his pocket. By renting a property, he likely generated enough cash to put down on the property that he wants to buy if he's using a 3.5% program. So I found it truly fascinating that even if we applied best case scenarios to the rent hack and worst case scenarios to ownership, reasonable worst case scenarios, guys, right? Because I know somebody out there right now is jumping up and down and saying, no, Mark, the worst case scenario is we enter into the Great Recession all over again and property values crash. Well, guys, we've talked about that in length. And until there is more supply than demand, there's nothing that's going to push property values down. And supply can come from a variety of places. Builders can suddenly start building more homes and instantly have inventory available. We know that's unlikely. Supply can come in the form of all of a sudden a lot of people want to sell their properties. We saw that during the pandemic because people wanted to relocate. Well, guys, right now with interest rates in the sixes and the vast majority of the population having a rate far lower than that, I think 40% of households don't even have a mortgage. There are not a lot of people who want to sell, cash in that 3% rate and go out there and buy something at 6 or 7% interest and at an appreciated sales price. So it's unlikely that the vast majority of people are going to wake up and want to put their property on the market. So that's not going to relieve pressure on the supply side. And then lastly, the most likely place is foreclosures. And yes, we're seeing more foreclosure activity. But again, 40% of the population doesn't even have a mortgage. And the vast majority of people have a historic low interest rate and a load of equity. So even if they lost their job and went belly up, they're likely able to rent their property out so somebody else can pay that mortgage off for them. Or what would most likely happen is they would sell the property and that would bring some inventory to the market. But there's just no indication that enough inventory is going to come to the market to crash this party. Yes, it's uncomfortable. Yes, it's frustrating. Yes, prices are high and it's expensive to buy a home. But right now, with where everything's setting up economically, all of that seems to be supported. So anyway, guys, thank you for letting me get that out. I thought that was fascinating that he created this rent hack and was generating income from paying rent. So I wanted to share that. But anyway, guys, you hear the music. You know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this commercial break. We'll be back with more of the show, and we're going to dive into those questions. We'll be right back. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards, and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark-Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-Eitel, and you are tuned into my very favorite real estate and mortgage show of the week of all time, the Mr. Mortgage Show. Thank you guys for spending a bit of your day with us. We do appreciate your time. Guys, if you've got questions or comments, you can call or text 855-462-7292. That's 855-462-7292. Jen is standing by, womanning that hotline. Actually, she's not standing by. She's already jumping around back there, taking some calls because we kicked the hornet's nest, I think, with that opening segment. And guys, I alluded to what was going on post the bailout of Silicon Valley Bank, and I think it was Signature in New York. And it's super interesting, right? Because we're seeing a flight to safety. And that's what lowered interest rates during the last, week or so, was a lot of money went back into bonds and mortgage-backed securities, and that lowered the rate. So when prices go up, the interest rate goes down. And guys, I'm not going to go back into that. We covered that in length last week. If you want to hear that again, you can go to mrmortgageradio.com. That's mrmortgageradio.com and click that very top link, and it'll take you to the podcast page. And Jen has posted last week's show up there as a podcast episode. So we went into mortgage-backed securities and how that controls interest rates and why that's not a bad investment. It got a bad name because that's where Silicon Valley had tied up all their money, but it had nothing to do with the quality of the asset. It had to do with the interest rate. But anyway, the flight to safety continues in that a lot of people that we're dealing with see how fragile the banking system is, and they're frightened to leave anything over $250,000 in the bank because, my God, we saw, billions of dollars in bondholders' wealth wiped out with that credit-suisse takeover. And I mean, the stroke of an eraser and billions of dollars were gone. And that scares the heck out of people. And tangible assets, real tangible assets, gold, silver, all precious metal classes are getting a lot of attention right now, as is art and jewelry. But for me, I'm excited because people are talking about buying investment properties and putting their money in what's most likely the safest asset, and that's real estate, and generating some positive cash flow along the way while protecting that asset. I mean, we've talked to people who had just kind of poked around maybe buying some investment property over the last couple years, and now they're all in. So it's been a quite interesting week. I think that's a direct result of the exposure of the banking system. Because remember that old story with the emperor's new clothes, and he's walking down the street naked, and he's convinced that he's got this beautiful suit of clothing on, and everyone in the room except him, or in this case on the street except him, realizes he's naked. Well, that's got to be what the banking system feels like right now, because as soon as more than 10% of the people want all their money back out of the bank, boom, we're in trouble. And we saw that come to light. So we can dive into that if you've got questions around it. The good thing is real estate seems to be a solid safe haven in all of this, which is good for me and good for you if you have any interest in buying or selling or refinancing some real estate. But I know Jen's got a load of questions back there, so let me toss it her way and we'll get the first question on the air. Hey, Jen, what do we have?
Robert sent this one. I'm ready to sell a small strip mall I own, and I'm curious if I'm allowed to 1031 exchange the proceeds to buy multiple properties. I'm looking at 3 separate 4-unit properties. Thanks. This is my first 1031.
Hey, Robert, that's a great question. And 3 is the magic number. So in a 1031 exchange, you can buy up to 3 new properties. If you go over the 3 property rule, then the value of the new properties comes into play. There's a rule where you can't exceed the value of your current property by more than, I think it's 200% if you buy more than 3 properties, but I don't remember off the top of my head. I'm happy to get you in touch with a directory of 1031 exchange facilitators, though, and you can pick somebody in your area if you haven't already. And guys, most of the time, it's an attorney or a title company. There are some dedicated 1031 exchange providers, facilitators, but most of the time it's a real estate attorney because they have to hold that money in escrow on your behalf, and it's tax-free during this exchange period. So there are IRS rules that have to be followed. But my man, brilliant question, and 3 is the magic number. And as I remember, until you go over 3 properties, I think you're going to be fine. Should you go over 3 properties, then the value of the new properties does come into question, though. But great question. I appreciate that one. Hey, Jen, do you have another one ready?
Peggy sent this text. I heard my bank may be reducing the available credit on my equity line. Can they do this? I don't really use it, but this doesn't seem fair.
Hey, Peggy. Yes, they can. So there's a lot of fine print in an equity line, and we saw that happen during the housing crash of the early 2000s, the Great Recession, if you will. And an equity line by nature is the value of it, or the availability of credit is determined by your equity. So in that instance, values were going down. So they started closing lines and greatly reducing the availability of it. So I haven't heard of any banks that are doing that, but that may be happening. They might be a little bit shell-shocked by what's going on and need to pull some of that debt load off their balance sheet, and in order to keep it balanced in relation to the cash on hand, the liquidity. So I don't find it hard to believe, but to answer your question, yes, the banks can do that, as unfair as it feels. And this is one of the cons of an equity line, if you don't need the cash and you're opening it up for that rainy day fund, is there are certain circumstances in which it can be reduced or even closed completely. Not to mention that interest rate is going up every time the Federal Reserve increases interest rates. And a year ago, those things were so low that if you could qualify for one, you know, everybody was grabbing an equity line. It just made so much sense. But if you're looking at the cost of funds now, those equity lines have increased considerably and are increasing every time the Federal Reserve moves that overnight rate. So, but brilliant question. I'm sorry that you're going through that because it is frustrating, but yes, certainly within the rules. If you need some help or you have more questions regarding that, just give us a shout off the air. I'll be happy to answer any questions that I may be able to help you with. But guys, you hear the music, you know what that means. That is my cue. We'll be back in a few. Sit tight. On the other side of this short break, we're going to be back with more of the Mr. Mortgage Show. Let me tell you a little story about a man named Jed. Well, this is not a story about Jed, but it is a story about Mary. Mary is an awesome single mom who's been raising her daughter in a 1-bedroom, 1-bath apartment for the last 11 years. That's right, 1 bedroom and 1 bath. Hey, they've made the best of it. They've got bunk beds in there and it's worked. But her daughter's now a teenager and it's becoming a challenge, especially sharing that bathroom. She decided to jump in and become a homeowner. We got her approved with an FHA loan. That's right, I said it, FHA. Hey, if your agent's telling you FHA and VA loans are not getting accepted, you are working with the wrong agent. Contact me and I'll get you in touch with a really great agent. Hey, but back to Mary. She jumped in and she is now a proud homeowner. They have their own bedrooms, but more importantly, their own baths. They couldn't be happier. Guys, if you'd like to learn more, check out MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark-Eitel, NMLS 1929005. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark-Eitel, and you heard the man. You are tuned into the Mr. Mortgage Show, and if you've got questions or comments, you can call or text 855-462-7292. That's 855-462-7292. Jen is standing by, womanning the hotline, and she'll be more than happy to get your questions on the air. If you prefer to shoot us an email, just visit MrMortgageRadio.com. That's MrMortgageRadio.com. Scroll to the bottom of the page and hit that email icon, and you can shoot your questions over that way. But hey, speaking of Jen and speaking of your questions, let's keep the train rolling. Hey, Jen, do you have another question ready?
Zach is asking, I want to ask my parents to co-sign a mortgage, but I want to have a game plan. So how long until I can refinance into only my name? And what happens to their house if I slip up and go into foreclosure? Thanks for your advice.
Hey, Zach, that's a great question. Congratulations on wanting to bring a plan to your parents, because I think that's brilliant. The first question, how long will it take until you can refinance the property into your own name? I need to know a lot more before I can answer that, because oftentimes this situation stems from either the credit, the income, or the assets of the child doesn't qualify. So the parents are stepping in to fill the gap in one of those places. So the obvious answer to the question is, as soon as that third leg of your stool, if you heard that episode a week or two ago, the three-legged stool mortgage analogy, credit, income, and assets, the fourth leg is always the property. But until you get all three legs of your stool in place, you might have to wait until you can refinance it into your name. But I'm happy to help you put a plan together in how to achieve that next step. But brilliant question on what happens if I go into foreclosure. So I love that you're thinking worst case scenario, because then you can be prepared to answer that question for your folks. So nothing will happen to their primary residence, right? They're not going to lose their current primary by you losing this property. However, it is going to negatively impact their credit and drag them through the foreclosure with you. So my suggestion to you, Zach, would be have a plan in place showing them exactly what you would do if trouble was on the horizon. And most likely the right move is either sell the property, assuming that you've got some equity, cash them out of it and, start over, or could you rent the property, hopefully for a profit, and show them that there's an opportunity that this could later become an income producing property should you wish to move or, as you mentioned, slip up. And let's hope that doesn't happen. So I would look at the comparable rents for the neighborhood and say, okay, mom and dad, this property could rent for X amount of dollars, and the mortgage payment, all in, taxes, insurance, principal, interest, if there's a homeowners association, all in, our expenses on this property are Y. So you can see that X is greater than Y in this example, and we'll be in great shape. And then somebody else will be paying down the debt for us while we build equity. And if you need help with that rental comparison strategy, shoot me the property address of the home you're looking at, and I'll run a value report for you. And in that value report, it shows the projected monthly rental amount should you have to rent it. And that's not an appraisal, but it'll give you a very, very good idea of the current market value, the current market rent. And there's a load of comps in there and neighborhood statistics. You might find it helpful to take that data to your folks when you present them this idea. So would be my suggestion. Show them that if you had to rent the property out to bail yourself out, you could. Worst case scenario, I can sell the property. So I would come to them with all of that in place kind of as a game plan. And if you think that property value report would be helpful in showing them the data, I'm happy to run one of those for you. Just go to MrMortgageRadio.com, scroll to that I think it says free value report. Click on that link, and there's a place where you can give us just a little bit of info about the property, and I'll email you back that value report. So, but my man, congratulations on being ready to take this step. And I love the fact that you want to come to the conversation with your parents prepared, and I'll help you any way I can. Anyway, let's keep the train rolling. Jen, what do we have? Another question? Okay, what do we have?
Dawn sent me this one. My boyfriend and I have been together for 3 years and want to buy a house together. He makes more money, but I have better credit. Does it matter who is the main borrower and who is the co-borrower? Does this affect who owns more of the house?
Hey, Dawn, that's another brilliant question. And it's not uncommon that the lady leads the pack with the credit score. But to answer your question, it's really ego. It doesn't matter who's the borrower and who's the co-borrower. We're using, in most cases, the lower of the two middle scores. So if you've got the higher score, we're going to use his middle score in underwriting. There are some programs that let you average the scores, but more times than not, we're using the lower of the two middle scores, the two borrowers' middle scores, because you each have 3 scores. But to answer your question, who's borrower and who's co-borrower is usually just ego. And that's also who goes on the deed first. Usually it's just an ego thing, who's on there first. Because if you buy the property as joint tenants with right of survivorship, which is almost always how married couples and people in a committed relationship who are buying a primary residence together, most often that's how the property's purchased. And in that case, you both have equal ownership. Should one of you pass away, the other would then have sole ownership of the property if it was just the two of you as joint tenants with right of survivorship. So I hope that answers the question. If you need some more information regarding that or you want to dive deeper, I'm always happy to have a conversation. But congratulations on making the move. I hope this works really well for you, because the other side of an unmarried couple buying a property together is oftentimes people think it's super easy to break up and split up the property, right? Just quit claim deed me off the property and write me a check, which happens a lot. Now, I'm not suggesting that you guys aren't going to live happily ever after, but just know all of the details of the transaction. If you two decide to separate and one of you wants to keep the property, the only way to get both of you off the mortgage is to refinance it in one person's name, because quit claim deeding the property from the both of you to one of you will take that person off the ownership instrument, but they'll still be on the debt instrument. And if you quit claim deed yourself off the property, but you're still on the mortgage, should something happen later and he go into foreclosure, you're going into foreclosure too. It's still, that debt is still on your credit report. You're still responsible for that debt. So just know that, because a lot of people get tripped up on that part of it, because we always assume everything's going to be happily ever after, but we don't often think about that part of it. So I just wanted to mention that, because that part of it often goes unmentioned. So I just wanted to throw that out there. But if you need more information, you can always reach out. I'll be happy to walk you through it from start to finish. But guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the show. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that credit-suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are locked and loaded right here on the Mr. Mortgage Show. Thank you for hanging out with us for a little bit, spending some of your day with us. We greatly appreciate it. Hey, if you've got questions or comments, you can call or text 855-462-7292. That's 855-462-7292. Jen is standing by womaning the Anytime hotline, and she'll get your questions on the air. If you prefer to send those via email, just visit mrmortgageradio.com. That's mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. And man, we've had some awesome questions so far. I hope you guys are enjoying it. Let's throw it over to Jen and get another question on the air. Hey, Jen, what do you have?
Vivian is asking, I didn't want to refinance my 3.25% interest rate, but with all the news about the economy, I want to get my monthly expense down. You've mentioned a special loan for this before. I think it's a rec loan. Can you explain this again? Thank you.
Hey, Vivian, that's a brilliant question. And I know there are a lot of people that are in the same boat that you're in, right? You locked in this amazing forever interest rate, and then here comes inflation, here comes some challenges, whatever the case may be. I know a lot of people are getting caught off guard with where their credit card interest payments are now. I mean, I saw a statistic the other day. I think the average used car loan in this country is now over 10%, and the average credit card is nearing 30% interest. And that just blew my mind. I mean, I've seen some crazy car payments on credit reports lately, but I was super surprised about that credit card number. So crazy, crazy numbers out there. And then with all the uncertainty, I totally get considering moving out of that low interest rate, tapping some of the equity, paying off that other debt. And then the magic in all of this is you've got to manage so you don't run up more credit card or other loans in the future, right? Because it becomes super tempting to do that. So what I believe you're referring to is the REC, R-E-C. REC stands for Reduce, Eliminate, and Consolidate. The REC refinance is designed to reduce your overall monthly payments by either eliminating some debt altogether or consolidating some debt. So paying off credit cards, paying off car notes, those type of things. We've even helped some clients pay off their equity line because equity line rates have gotten so high that they're getting frustrated. So yes, you've got an amazing interest rate in the threes. And keep in mind, you can always buy your interest rate down in a refinance also. So the spread between where you are and market might not be as bad as you think. So I get it. Most people are in the same boat. They wanted to hold on to that interest rate forever. But we're talking to people every day. I'm working with a client right now. They're in Port St. Lucie. There was an illness in the family, and they ran up a bunch of medical expenses and paid for a lot of it on credit cards. And that was a manageable payment when interest rates were at all-time lows, but they're now in that high 20s classification interest rate-wise, and they've just had enough. And they're refinancing, and their interest rate is going up. For sure it's going up, but their monthly outflow is going down quite a bit. And because of that, it's going to give them that cushion that they need each month to get back on track and just really allow them to breathe a sigh of relief because they're getting buried by those credit cards at the moment. So I hate spending equity on financed purchases of the past, but I get it that sometimes in life we've got to do what we've got to do. So that REC refinance is what you're talking about. We advertise that loan quite often. And if you have questions about that, I'm happy to jump in and walk you through it. But we need a net reduction in monthly outflow to qualify for that loan. And more times than not, we're able to do that. So I appreciate that call. I'm sorry that you're in this circumstance, but if you need help, I'm happy to jump in and walk you through that REC refinance. Just give us a call off the air and I'll take all the time that you need to get all the questions answered so you know exactly what you're working with. But I greatly appreciate it. Hey, I'm going to toss it over to Jen and see if we can get another question.
Alex sent this one. If we sell our house and hold the mortgage, can we count the mortgage payments as income when qualifying for a new purchase mortgage? Thanks.
Hey, Alex, that's a great question, my man. And yes, you can. So that just like if you were holding that property and renting it, if you sell it and provide seller financing for the new buyer, that's income to you. So you can absolutely count that in your income bucket when you apply for a new mortgage. And surprisingly enough, more people are considering this because interest rates have gotten to a point that holding the note And doing a seller finance deal starts to become attractive because you can charge 7, 8, 9% interest in some cases and help somebody get into a property, because most often if they're looking for seller financing, it's because they can't qualify for traditional financing. And because of that, they're often willing to pay a bit of a premium. So it's not uncommon for seller financing to charge a slightly higher interest rate. But, I'm not suggesting you gouge anybody. I'm just saying that in a higher interest rate environment, suddenly holding a mortgage as a seller becomes attractive. You're able to garner a nice return on that investment, if you will. So if you don't need the money, here's a perfect example of how this can work. And this is a little off topic, but we had a client call and they own a property, and the property is worth a little over $1.4 million, and they owe $500,000 on the property, and they want to sell the property and downsize, and they really don't need the money. They can take a large portion of that capital gains free, but they are going to have to pay gains on a percentage of it because they have such a large equity position proportionate to the value. So what they're considering, and the reason they called was they wanted some assistance in walking through this, they're going to sell the property and take a 30% down payment, which will pay off their $500,000 mortgage, and then they're going to hold a $1 million mortgage. And the numbers are close to that, but I'm using round numbers for discussion. So they're going to charge interest on $1 million, and they're going to do a 36-month balloon, which allows a buyer to come in there, put 30% down, get themselves mortgage ready so they can refinance in whatever, 12, 24, 36 months. And this person is going to generate a nice cash flow from that property because they don't need that cash right now. So it's just interesting because you hear me talk about it all the time, guys. If you've listened to the show for any length of time, I always say look past the headlines and find the opportunity. There's opportunity in every market, up market, down market, stagnant market. There's always opportunity. And right now, people who have a load of equity with where interest rates are, it may make sense, and it sounds like to Alex it makes sense, to hold the note and do a seller finance deal and then earn that interest as income. So I hope that helps. I do think that's a brilliant strategy. I don't think it works for everybody. You've got to have enough equity in the deal for it to make sense. And in the example that I just gave you, they needed enough equity to pay off that first mortgage. Luckily, it's, under 30% or 33% of the value of the house. So they're able to make all of that work. But I think it's an interesting strategy. And as I mentioned, there's almost always there's opportunity in every market. So guys, you hear the music, you know what that means? Sorry about that. I almost fell out of my chair. You hear the music, you know what that means? That is my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the Mr. Mortgage Show. We'll be right back. Have you recently gotten a mortgage approval and now you're wondering, how do you know if it's a good deal? I mean, the wrong decision can cost tens of thousands of dollars in fees and interest rate. Is any of this negotiable? Is this a good rate? Guys, it's mark-eitel, host of the Mr. Mortgage Show, and we are happy at no cost or obligation to you to take a look at that fee sheet for you. We'll go line by line through it, and one of three things will happen. One, we may congratulate you on getting an awesome deal, and then you can exhale and move forward knowing you did great. Or two, we may be able to point out some places in that fee sheet that you can go back and renegotiate a better deal with your current lender. Or three, and guys, this one's my favorite, we may be able to offer you even a better deal, saving you in fees or interest rate or both. Guys, there's no obligation. Just go to MrMortgageRadio.com. That's MrMortgageRadio.com. Click on that fee sheet review icon and we'll do the rest. It's mark-eitel, NMLS 1929005.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is mark-eitel, and you heard the man, 855-462-7292. You can call or text that number, 855-462-7292. is the Anytime Hotline, and Jen is standing by. She'll get your questions on the air. If you prefer to do it via email, mrmortgageradio.com, mrmortgageradio.com. Scroll to the bottom of the page, click that email icon, and you can shoot your questions over that way. But speaking of your questions, Jen mentioned that we've got a bunch of them over there, so let's try to get through a rapid round of questions. Hey, Jen, what do we have?
Caroline has a question. I'm still unclear on how the buying down and interest rate works. Does the seller pay for the cost? Is it a 1, 2, 3 buy down better? Thank you.
Hey, Caroline, that's a 3-2-1 buy down, but you are on the right track. So for me personally, and it's only because I've been doing this since 1999, and I saw what payment adjustments did to people during the housing crash and the Great Recession, I'm not a fan of the 3-2-1 buy down. It's a step up payment, right? So you buy the interest rate down 3% the first year, 2% the second, 1% the third, and then it goes to where it started and stays there for the rest of the loan. So it adjusts up each year. Not a huge fan unless your plan is to get out of the property, in a relatively short period of time, because you save a considerable amount of money in years 1 and 2. I'm a big fan of the permanent buy down. And to answer your question, the seller can pay for it, or you can pay for it as part of your closing costs by using discount points. But certainly the seller can provide the concession, if you will, and that money can be used to buy the rate down. And think of a rate buy down fee as prepaid interest. So the lender makes money by collecting your payment each month, a portion of which is interest. Now, they'll lower that interest rate and make less each month, but they're charging you a fee up front to do it. So it's a one-time fee paid up front, and in the case of the permanent buy down, the interest rate is lowered, and then it stays there for the life of the loan. So for me, only because I saw what adjustable payments did to people, I'm not a fan of the 3-2-1 buy down unless your game plan is to be in the property for 5 years or less. So that's just my personal opinion, and I'm happy to spend more time with you and help you understand it. And if you're looking at an exact scenario, if you've got a property in mind, I can run the numbers for you with a permanent buy down and a 3-2-1 buy down. But I appreciate that question. That was a good one. Hey, Jen, what else do we have over there?
Randy sent this one. My agent is suggesting waiving my inspection. I know you don't recommend this, but things are getting crazy out here again. Any advice on how to do this while still protecting myself? I'm looking in Sarasota, Florida.
Hey, Randy, clearly you listen to the show, because I am not a fan of waiving anything unless you're sitting on the back of a convertible going down Main Street in a parade, and then you can wave at everybody. But this drives me nuts when we waive inspections and we waive appraisals and we waive the things that protect us as buyers, not because we want to nitpick or negotiate a seller down to a lower price, because we want the option to walk away from a deal that doesn't make sense. So the best strategy that I've seen for getting the seller comfortable with the inspection period has been crafted by a friend of mine, Juan, who's also over in your neck of the woods. He's a bit north of you in Tampa. But he has what he calls a worry-free inspection period when he's making an offer to a seller. And basically they agree to not come back at the seller and ask for either concessions, repairs, or a lower price unless the total deficiencies, if you will, that were uncovered in the inspection total more than X dollars, $5,000, $10,000. Pick a number that you're comfortable with. That way the seller knows you're not going to come back and nitpick them, but that you just want to look under the hood and test drive the car before you buy it. I think that's reasonable. So he was really successful with that strategy during all of the craziness, and I encourage that. And the second part of that is get the inspection done quickly, out of the way early, tighten that inspection period up so the seller's not in limbo. And I hope that helps, but you're right. I'm not a fan of waiving any of the rights of any contract, be it a buyer or a seller. So I appreciate that question. Let me toss it to Jen for another one.
Carlos has this question. What happens to our mortgage if our bank collapses? Would we still be required to pay? That's a great question, Carlos.
Hey, Carlos. Yes, I'm chuckling because I wish it was that easy, right? I wish it was that easy that if the bank fails, you don't owe the money anymore. But that's not how it works. So when the bank loans you money for a mortgage, that mortgage becomes a saleable asset on the bank's balance sheet. So in the case of a collapse, the assets of the bank are just sold to another lender. In most cases, it's another bank, but they're going to buy the assets of the bank. So let's use SVB, right? So SVB made a lot of mortgages. Those mortgages are now going to be payable to the bank that buys SVB and no longer SVB themselves. So I wish it was that easy, my man, but you are still going to be required to make your payments. It's just going to be to whatever bank, financial institution that buys the assets of the failed bank. So I hope that answers your question, but that was a great one. We've had a lot of questions around that in the last week or so. I appreciate that. Hey, Jen, do you have another question?
Leanne sent us this text. I'm recently divorced and re-entered the workforce in December. I've heard I need 2 years work history when applying for a mortgage. Are there faster options? I could pay cash, but prefer not to. I'm open to a higher rate if there is a creative option.
Hey, Leanne, that's a great question. This topic doesn't get enough coverage, if you will. So you heard, if you listened to the show, it was a week or two ago, I talked about the four-legged stool, right? Your income, your assets, your credit, and your property are usually the four legs. Well, really, there's a fifth leg. You need that employment verification in most instances. But here's the thing. If you've got a load of assets, there are programs that won't even require you to have a job. There's a program that if you're able to pay in full for the property, they'll loan you money. There's always private investors also that if you can put down 25 or 30%, and if you can pay cash, you certainly can put a larger down payment down. And most of these programs do require 25 or 30% down payment. Some of them are as little as 20%, but just know they'll require a larger down payment. But yes, to answer your question, you don't have to wait the 2 years. And we see a lot of this circumstance surrounding divorce where one spouse ran the household and left the work environment, and it's often the wife. I know that gender roles are changing, but it's still pretty traditional that the wife manages the household and raises the children. And because of that, she leaves the workforce and is now, her job is to run that family. And I know firsthand how difficult that can be because the woman that runs my family is a rock star. But I say that because we see this happen. You're now divorced and you're re-entering oftentimes the career that you left, and you might find it no difficulty at all in getting a job, but now you haven't had work history for a while because you were running the household. So this is exactly where we see it. And then oftentimes the divorce settlement is enough money to pay cash. So you've got somebody who hasn't been in the workforce for a while, might have all the skills in the world, is wonderful at running a household, oftentimes has amazing credit too, which is one of those legs on that stool, and now faces the difficult task of going out there and qualifying for a mortgage because they haven't been in the workforce in a while. So I say all that just to mention that this is not an uncommon circumstance. And to answer your question, yes, there are programs available that will not require you to wait that 2 years. So I appreciate the question, and I'm happy to dive deep with you if you need more information around that. So, hey, Jen, can we squeeze in one more question?
Eric is asking, how long is the process for a reverse mortgage? I've heard it can take a while. Thanks so much.
Hey, Eric, that's a great question. That's an easy one to go out on. It's, 30 to 45 days. If you've got 60 days, you've got more than enough time. It gets underwritten like a traditional loan, but because there are fewer lenders that do reverse mortgages, it does occasionally take a little bit longer, but I would plan on, let's say, give it 45 days. That should be more than enough time. I appreciate that question. Hey guys, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Man, time flew by for me. I hope you had fun. We sure did. Jen and I will be back next week right here, same time, same station. If you need us during the week, check out mrmortgageradio.com. That's mrmortgageradio.com. Hope you guys have an amazing week. We'll see you next time right here.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.